Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Rima. Guys, good morning.
Hi, morning.
Hi, good morning. It's a Thursday morning. Fresh highs for the S&P 500. The FIs bought in the cash market in India. Yesterday, the earnings season has picked up in full swing now. Weekly sensex weekly expiry today, so lots on the tap. And the gift nifty is suggesting a positive start.
Well, that's right. A lot of cues and a bit of a feel-good factor now is coming back into our market. So that's good news. And hopefully, just going by all the sound bites we have heard in the last 24 to 36 hours, it appears more or less this war should be towards the end.
Absolutely. Just some sober news also coming in this morning, right? Mark Mobius, the legendary emerging markets investor, has passed away. That's what we kind of sort of learn. Almost ageless, right? I mean, every time he used to, he's been a regular on CNBC TV18 for 25 years now. My first conversation with him, I was sort of thinking back on the way here, perhaps was in 2004. And it's kind of sort of always looked the same, white suit and sparkling, whenever he sort of walked into the newsroom. So those are some visuals coming in with Mark Mobius in the CNBC studios, interactions, etc. So, really popularized emerging markets as a theme long before it became fashionable to say that I'm an emerging market investor. Racked up a lot of air miles, traveled around the world, 100 plus countries, and really feet in the ground, trying to find the next investment idea. So that's a tribute. By the way, I must say, always India bull as well, Rima and Nigel. And if Rakesh Jhunjhunwala was like the Indian India bull, I can't think of anyone else more bullish than Mark Mobius consistently through his investing career. At least whenever we spoke to him, I never heard him once bearish about prospects for the Indian economy or the companies here.
So I interacted with him in December. He had come on the channel, and at that time I asked him, what's your weightage on India? And he said it's 20%, but I would be looking to increase it further to 30%. So always an India bull, and so astute, right? Through the years, in the last 20 years that we've interacted with him, I think ageless is the right word. Very sharp mind.
Well, that's right, ageless, and may the departed soul rest in peace. An India bull and someone who was always great to have on the channel, so we'll miss him a lot.
Absolutely.
It's pouring in, by the way, on Twitter and
as they should.
Everyone's
right?
morning.
That's news coming in. One more sort of legend, no more with us from the investment world. Let's just track markets as we do here, right in the word go. So in terms of where we stand this morning, oil prices are well behaved. Brent oil at about $94 a barrel or so. So there's no real 94, $95 in that range, but nothing untoward has happened. The S&P 0.8% higher. By the way, the S&P is closed above 7,000 for the first time ever. So that's something. Nasdaq 1.6%. It's the first record high since last October, and it's an 11-day consecutive run. So that's again something, right? Now, there are reports that the US and Iran are weighing a 2-week ceasefire extension to allow for more talks to be possible. And this is something that was told to us right at the word go when the ceasefire announcement came, that, 2 weeks, but it's possible. There is potential for extension. So we knew that was possible. So this is, of course, being seen as good news, that you don't have a hard stop and then fighting begins or something of that sort. That's not the base case at all. And I think that is that feeling, that sentiment is getting solidified. Scott Bessent, and this is important from an India perspective as well, Scott Bessent reaffirmed that the US would not renew general licenses that allowed for the temporary sale of certain Russian and Iranian crude oil. We had started to buy a lot more of Russian oil over the last 1 month, 1.5 odd months since the war in the Middle East broke out. So what happens to this is the question. I think the deadline for this also expires in the next 1 week or so. So we'll see, and we'll get more perspective on this one, because we're diversified away from the Middle East crude, which of course is not getting out of the Strait of Hormuz too. buying Russian crude once again. Just a couple of stock-specific news flow. Snap rallied 8%. It's planning to lay off about 1,000 employees. It's about 16% of its permanent workforce. That news came out last night. Software stocks have not had a bad session last night. So you look at the Infosys ADR, 2.5 higher. Globant was up 5%. The Wipro ADR was up about 2.5% as well. Of course, IT stocks yesterday had a decent rally. So the point is, you got to see the ADR equivalent value of where stocks are trading here, because the underlying is here, and what's happening, of course, there is a derivative. Now, the levels in terms of where we are at, the targets are 24,300 and then 24,800. Very simply put, on the upside, 24,300 is the first target. It's the level we put out yesterday as well, and once 24,300 is taken out, potentially we head to about 24,800. Supports are 23,800. So between Monday's close and yesterday's open, there's a small gap. And 23,800 is the lower end of that gap, which becomes the first support. And after that, you got the 23,465 level, which starts to kick in. So this is broadly the range that we are working with. It's not a big range. It's about 1,000 odd points on the Nifty. GIFT Nifty will give you a quick sense of how we're likely to start before we move any further. 80 points higher once again. I must say, yesterday, a very, very vibrant screen with lots and lots of small and mid-cap stocks which were rallying very, very hard. Advanced decline kind of bore that out, but you really had to look through the list for the real breadth of the market. Varied stocks from all kinds of sectors doing very, very well. Nigel has walked across to the wall with what's happening on the positioning. The expiry today, as Rima pointed out. Nigel, take it away.
Well, that's right. There's a lot of talk actually about India still around 3.5 to 4% away. While the global markets like the US, they are making fresh highs and they've also recovered to pre-war levels. But I did a closer look and it appears the broader markets actually have crossed the bridge. They're actually trading above pre-war levels. If you look at the mid-cap index, only around 0.5% away, while the small-cap index is actually higher in comparison to the pre-war levels, though the Nifty is still closer on 3.5 to around 4% odd, and I expect the Nifty to gradually make that up and move towards the pre-war levels as well. But the breadth of the market is good, and the broader markets are seeing traction. That's why your portfolio is feeling good. But coming back to the data points that we got yesterday, the FIs, they have turned marginal buyers. At least they're not selling, which is good news. And there was a bit of a role reversal yesterday because the DIs that have been backing up this market, some kind of unwinding, some kind of small selling out there. The FIs who buys, the net institutional number was actually positive. On the index and for the markets on the whole, it appeared on the Nifty there was about a short covering that did take place. While on the Nifty Bank, there is a sense that that index is finding its form and that, in fact, there was some long addition out there. This is for the market on the whole. Though from an FI perspective, they unwound positions big time. Both on the long as well as on the short side, they unwound positions out there, while the short positioning continues at around that 79% or thereabouts. Now remember, from the recent low, the Nifty has bounced closer around 2,000 points. So big bounce is what we are seeing from the lows that we saw, towards the end of March. But you look at the kind of short covering that we're seeing. The similar time frame, you should get the FI net short positions. That's down by around 60,000 contracts. That's 25% short covering is what we're seeing from the FIs on their shorts. While the clients as well, they have been unwinding some long positions because they were backing up this market. So some kind of profit taking, the long positions from the client side, that's down by close to around 50,000 contracts. But that graphic point tells you the power of short covering. 2,000 point rally and massive short covering from the FIs. Well, looking at the Nifty, well, there appears as a short straddle at play. And the broad range will be these 1,000 points up for you on the screen, 23,700 to around 24,700. Let me explain that to you. There's action at both the 24,200 call, 24,200 put. You put it together, the premium's close to around 500 points. So you add and deduct this 500 points from this level of around 24,200, and that's giving you the broad range. In the near term, though, if you're looking for a specific range, that is a strategy on the option side. But in terms of a specific range, well, the reference point on the downside will be around the 20 DMA. Till this holds out, you'll be feeling that the bulls have some unfinished business on the upside. And in terms of upside levels, 50 DMA important. This is simple moving averages. And then you're looking at the 200 DMA. So that's between the 24,500 to around the 25,200 odd mark. The Nifty Bank, as I said, that's been finding its form. That got hit harder. Well, it's a little bit away from that 200 DMA. So we'll have to keep an eye out on that particular level. It's leaving the reference point, which is the 20 DMA. So we start off in the green. This market has turned into buy on dips. The global cues are positive as well. And I expect the broader market outperformance to gain traction even from here on.
Thank you very much for that. Let's get some equity calls then. It's Lawrence Belanco of CLSA who says that after forming a price momentum divergence into the March lows, the Nifty has staged a sharp rebound. The recovery rally is now testing resistance at 24,300 to 24,400, an area defined by the 50-day moving average. He says that a decisive break above this resistance zone would place the index back into the trading range of the second half of 2025, with the 20-day moving average providing the next upside hurdle around 25,130. So basically, CLSA laying the markers for resistance for our markets in this rebound rally. The first one is 24,300, 24,400, and then you've got the 200-day moving average around 25,130. But let's get to the top story that we're tracking right now. There is renewed optimism for an end to the West Asia conflict as Pakistani Army's Chief Field Marshal Asim Munir held high-level talks in Tehran on a possible resumption of talks between Iran and the US. The diplomatic push came as the US and Iranian officials weighed a return to Pakistan for further talks after negotiations there ended last Sunday without a breakthrough. In an interview to Fox News, US President Trump was also optimistic that the war in Iran was close to over. Listen in.
Is this war over?
I think it's close to over, yeah. I mean, I view it as very close to over. You know what? If I pulled up stakes right now, it would take them 20 years to rebuild that country. And we're not finished. But we'll see what happens. I think they want to make a deal very badly.
Well, the markets at least seem to be behaving like the war is over. The S&P 500 hitting fresh record highs yesterday, crossing that 7,000 mark. The Nasdaq rallying for the 11th consecutive session. Great time then to get Drew Pettit, Director U.S. Equity Strategy at Citi, into the show. Thank you very much, Drew, for joining in. I know you're bullish on the U.S. market. Your S&P target for year-end is 7,700, which means a 10% upside from current level. But do you get the sense that just for the near term, that markets, the investors are getting ahead of themselves? There is some complacency with the kind of rebound that we've seen in the month of April because the blockade is still on. And as of now, it's only a truce deal. The war hasn't really ended, with both sides bridging the gaps between their asks.
I think markets are finally getting past potentially the worst of the worst, at least for the news flow around the conflict in Iran. I would say it's a really aggressive repositioning move. It feels like a big time beta rally. But structurally, I would say, at least on NASDAQ outperformance and what we're seeing on the growth side, that actually makes a lot of sense, because that's a way to play macro defense to us, at least in the equity markets, because that is really tied to secular trends, not the cyclical economy. I think if you look longer term, the one thing that really has changed, that the broadening thesis that you're going to get earnings growth from more parts of the US market and globally, that's going to be a little bit more difficult. I think when fundamentals kick in, you might see a more narrow market going forward.
Yeah, got that. Drew, you know, software stocks have been really hammered pretty hard, right? We got a bit of a very sharp move, actually. I think it was earlier this week, Monday or Tuesday. I think it was Monday. US software stocks jumped as a group. What's happening with that basket, Drew? And what's the sentiment like around those names?
It's just coming off really, really low levels. Sentiment's really poor. And honestly, the fundamental story longer term is still challenged. Like, look, we are underweight software. We do like technology broadly. We prefer semiconductors over software. On the software front, you've actually seen peaking quality. There's a lot of really high quality software names out there, good margins, good ROEs, but it's coming off really high levels and people see that as structurally challenged. Again, to my first point, like when we start talking about fundamentals again and get past the macro, the secular story probably makes more sense in buying semis and AI build out, not necessarily software from here.
All right. Hi, Drew. Good morning and good to see you. Well, in terms of global equity market positioning, I understand that you prefer some of the developed markets. US and UK are still top draw for you, while some of the emerging markets will have turned a little bit neutral. Case in point being India. Tell us your preference with regard to global markets, developed markets versus emerging markets, and also within the emerging market basket, Where does India come? And what's the trigger to turn overweight?
Yeah, so I got to give our global colleagues a lot of credit here, work really closely with them. We actually just went back overweight the US in the past week or so. That is not a long-lasting position for us. We've been bullish fundamentally. Tactically, it was a neutral for a while, just upgraded again. It's a way to play relative defense when geopolitical uncertainty lingers. On emerging markets, we kind of took that down. I would say broadly in EM, you do get some of the AI trade. We have a little bit more conviction in that in the US than EM. And within EM, still kind of assessing the situation. We think at least tactically, Latin America feels more insulated than Asia, at least from a price input perspective, and that effect of higher oil rates, even though they have come down off peak. And India, look, that's a neutral for us still. We think earnings downgrades have been happening. There's more to come, but in a relative sense, still not as I would say as cyclical and as concerning as other parts of Asia EM.
Is the oil shock, the rise in oil prices, a threat to the AI-led boom, to your mind? Because that's been driving the Asian markets. And we know all these data centers are guzzlers of energy. And also, because of the conflict, do you think the broad AI capex led, that $650 billion, which the top four, tech companies in the US were planning to build out this year, do you think that's going to be on track or it gets derailed?
So I think near term, the story is actually, when you think about inflation and the concerns around AI build out, it's memory pricing and compute. So you're still building that out. The longer term headwind is energy and how much you need to power data centers. So yes, if energy prices stay high for an extremely long period of time, yes, you're right. But I think the near-term narrative around the secular is still in the build-out. We are still building out AI infrastructure. Energy doesn't dent that in the near term. Chip pricing has actually been more impactful on CapEx and how much they can build with every dollar of CapEx they're spending.
Yeah. Got that. So, basically, Mark, going back to some of the same trades which worked before the war broke out, right? You kind of go back to that same similar setup.
Yeah, it actually feels a lot like what we were talking about in 2025 again. It's earnings growth is going to be a little bit more focused on tech and growth themes. The revisions on the cyclical side outside of energy, because again, higher prices, higher earnings expectations there. But outside of that, you get worried about consumer, for example. Are you really going to get upgrades there in industrials that are outside of the AI complex? So to us, yeah, it starts to feel like the earnings story of last year and a little bit more of kind of what was working going into this.
Drew, we'll leave it there. A good conversation. Thank you very much for joining us. Appreciate your time here on CNBC TV18.
Okay, thank you. Take care.
Take a quick break, but before that, let me just quickly get you the conversations which are lined up here. So 8:35, we'll have Equity Securities' Manoj Gori to focus on the consumer durables space. 9:20, we have Prashant Jain of 3P Investment Managers, a veteran really, talking to us, of course, about markets and his roadmap from here. We speak with the management of ICICI Lombard at 9:40 in the back of their fourth quarter numbers. 9:50, a discussion on the India-US trade deal talks resuming. I mean, that 40-minute phone call between President Trump and Prime Minister Modi. Towards the end of the program, Lata discusses the likely impact of delayed monsoon and fertilizer shortage on agriculture. And of course, the implications of rural demand. Ashok Gulati is a guest today on the show.
Time to slip into a short break, but we've got a lot of stock-specific action they're going to be tracking for you in our special Top 10 segment. We're looking at HDB Financial, ICICI Lombard, Oro Pharma, Rubicon Research, Swami Hotels, Delivery, and Brigade. All of them will be reacting to positive news flow. While you'll have, Bazaar-style retail, Tejas Networks, and GMR Airports that will be reacting to negative news flow. Take that break, come back, we get into further detail on all of these names.
Welcome back. Let's talk about stocks then. Our entire research team is standing by with CNBC-TV18's list of top stocks for the day. Let's talk about the earnings then. HDB Financial Services reported their numbers. Ananya, our new joinee, now joins in with her analysis.
HDB Financial Services delivered a strong set of numbers yesterday with loan book rising 11% year-on-year and disbursement rose 13% year-on-year. Its customer base also remains strong at 22.9 million. Now on the profitability side, NII grew 22% year-on-year and PAT jumped 41% year-on-year to 751 crore, while margins were a key highlight this quarter with NIMs expanding to 8.23%, while cost ratios also improved meaningfully. Coming to the asset quality side, so the asset quality also improved sequentially with GNPA declining to 2.44%, although slightly higher on a YOY basis, and return ratios were also healthy with ROA at 2.5% and ROE at 14.8% this quarter. Now, management commentary remains constructive. They are targeting growth at nominal GDP plus 6 to 7%. So following the strong set of numbers, the stock is likely to open in the green today.
All right, we'll watch that, Ananya, and thanks a lot for joining in. We look forward to having you on Top 10 more often. Well, let's go across to Yash. He's tracking ICICI Lombard. Morning, Yash.
Morning. So for ICICI Lombard, it's a top-down beat which the company's delivered in the fourth quarter. As far as the gross written premium is concerned, that saw a growth of about 17% on a year-on-year basis. The net earned premium, that also saw a growth of about 11%. The number which came on the NEP on the net earned premium side was 5790 crore, ahead of CNBC-TV18 poll of 5731 crore. The underwriting loss, that is coming at about 282 crore versus a loss of 72 crore. But the street was anticipating this number to be about 350 crore. So the underwriting loss is much lower than what the street was anticipating. Operating profit has come at about 546 crore. The poll which we were working with was a profit of 171 crore. Finally, combined ratio improving on a year-on-year basis at 101.2 versus 102.5, and also lower than the poll of 102.69. So a top-down beat as far as ICICI Lombard is concerned.
Thank you very much for that. Let's get in Ekta as well to tell us more on Aurobindo Pharma and Rubicon Research.
Well, yes, so Aurobindo Pharma is in focus because they've signed an additional product schedule with Merck Sharp and Dohme. So basically, this is going to be expanding their CMO or contract manufacturing business for biologics. The deal expands the biologics manufacturing partnership, which was in fact announced in May 2024. And the agreement also includes setting up a new greenfield drug substance facility called Unit 2. So this is a positive development for Aurobindo. Now, Rubicon Research has acquired 85% stake in Arena Life Sciences for around 176 odd crores. Aim is to strengthen the India play. Arena is focused on CNS therapies with a portfolio of 60 plus chronic brands. And acquisition gives Rubicon an entry into the Indian branded formulations market.
All right, thanks a lot for that, Ekta. Well, let's hop across to Manglam. He's here to tell us about some stocks in the news. Manglam?
Well, I'm looking at Sami Hotels first because the company has entered into a long-term lease agreement with the Inca Group for Inca Centers. This is for about 162-room upscale hotel in Noida, and this will increase their NCR inventory by about 32%. They double their upscale inventory as well, and it's part of a 2.5 million square feet, development that Inca Centers is doing. Inca obviously is the IKEA Group company, and this will give them direct access to retail, office, and high footfall experiential ecosystem. It's a positive news for the stock. Delivery, on the other hand, we have seen consistent selling by a lot of funds. Nexus is one which sold for 2 weeks in a row. Now, another 0.5% equity has been sold yesterday for about 186 crores. Remember, last week that sold about 1.6% stake in the company. They owned about 4.5% in the company, so it's fair to assume that this may be a periodic clean-out trade that may be underway by Nexus. The only thing that will support the stock, and did that yesterday as well, the buyers are fairly strong hands, so we have the likes of Nippon India Mutual Fund, Edelweiss Mutual Fund, Morgan Stanley, Goldman Sachs, all of them buying the stock. Finally, we have Bazaar Retail, which I expect to see some mild red today. Why is that? Because the insurer has settled fire-related inventory loss claim for their West Bengal warehouse. The company's loss, as per them, was 51 crores. They had estimated for 43 crores as receivable, but the claim has finally been settled at 23 crores. So it's that 20 crore hit that they will have to take on the estimated receivable as well. So as a result of which, we see some mild red on Bazaar-style retail.
All right, Manglam, and the big game this evening, Mumbai Indians bounce back?
Mumbai Indians should bounce back, just the way All Birds did yesterday, Nigel.
All right. I think I'll visit the stadium, because I think I need to play maybe a good luck charm or something like that.
If you have an extra ticket, you
Baglam.
know who to take, Nigel.
For sure, Baglam. Thanks a lot for that. Well, let's hop across to Vinny. She's here to tell us about some more stocks in the news. Hey, Vinny.
Hi, Nigel. First, good morning. And let's talk about Tejas Networks. That's the one that reported its numbers as well. Weak set of numbers that came in from the company. Revenue down 70% on a quarter basis. Even on a year-on-year basis, the revenues were sharply down by 72%. Full year also, revenues have seen a decline of more than 87% on a year-on-year basis. Now, overall, the company has reported the fifth quarter in terms of losses that they've seen coming in a row as well. Overall profit losses came in at losses came in at 211 crores for Q4 FY26. Last quarter, it was 196 crore loss that the company had reported. So weak set of numbers there, red expected here. Brigade Enterprises, that's the one we'll expect some green here on the screen as the company has signed a JDA for an 8.63 acre land parcel, which is in East Bangalore. The gross development value for this comes in at 7,200 crores. This is expanding furthermore their presence on the residential front over there. High demand in this tech corridor that's continuing and increasing the presence there is surely positive for them. GMR Airports, red expected here as well. The March 2026 passenger traffic data that's come down by 1.5% on a year-on-year basis. Q4 FY26 passenger traffic is at 3.1 crores, which is mildly up by 0.9%, so not much of a positive up move there as well. Muted traffic growth that's coming on the domestic front, mainly because of the disruptions that took place due to the geopolitical tensions, West Asia tensions that were there, and some upgradations that were going on for the Delhi airport. That's also seeing some bit of an impact in terms of the traffic data. That is why red expected here as well.
Thank you very much for that. Let's do a quick recap then of the top stocks to watch. Stocks with positive news flow are HDB Financial, ICICI Lombard, Aurobindo Pharma, Rubicon Research, Sami Hotels, Delivery, Brigade Enterprises. Stocks with negative news flow are Bazaar Style Retail, Tejas Networks, GMR Airports. We also have important earnings coming out, and two nifty companies, HDFC Life and Wipro, will be reporting numbers, and two F&O stocks, Angel One and HDFC AMC. So keep your eye on these companies as well as they report numbers later today. Manisha is now joining in for a complete roundup of all the action from the world of commodities. Manisha.
Thank you so much for that. Well, I'll start with the crude oil prices, which surprisingly have been very steady in the last 24 hours after a very volatile start to the week. The possible extension of ceasefire between US and Iran, a broader agreement, a second round of talks between the two countries, all of that has led the geopolitical premium coming off the prices. And then you have the dollar index as well, which is trading at a 6-week low, supporting a lot of these metal prices. So when you look at gold and silver, well, we are trading at a 1-month high. We have seen the coal prices decline to a 5-week lows with the crude oil prices coming down. And it is really the metal space which seems to be doing quite well. Apart from precious metals, it is the base metal prices where you have steel rebar trading at multi-week highs. It also has to do with the iron ore prices trading at around 1-month highs. The only metal that has seen a retreat has been aluminum. That is off its 4-year highs. The Chinese markets also are suggesting higher exports coming in from the country, and that's weighing onto those prices. Copper, in the meanwhile, is trading at a 2-month highs as well as markets look at recovery in sense of losses. Copper actually has fully recovered losses since the start of Middle East conflict. So strong gains continuing into copper, steel, iron ore, gold, silver, not so much for aluminum today.
All right, we'll, Manisha, leave it there for now. Thank you very much for joining us. That's a commodity wrap this morning. We'll take a quick commercial break here. We connect with Manoj Gori of Equirus to focus on the consumer durable space. Stay tuned, coming up in just a bit.
Welcome back. Deepan Mehta, Director at Rexar Equities, joins us on the show. Hi, Deepan. Good morning. Good to see you, Ben. Markets appear to be in a good mood. And we were just pointing out earlier that the Nifty still appears it's 3.5% away from those, highs that we saw pre-war. But the small cap index is 1.5% higher, telling you that all those losses actually have been recovered on a lot of stocks. From the broader markets, name a couple of names that you're looking to get in or you'll have got in and looking to build a position.
Well, good morning and thank you for having me on your show. No, I think that last few weeks we have stayed away from the markets. So I know that markets have, kind of retraced a lot of the losses. but still the uncertainty remains around what can happen in the Middle East. And although this earnings season will be fine, the damage caused by the Gulf War will be more visible in the June quarter, and how the inflation rate has moved up, interest rates, I think all of these things are certainly deteriorating. And now we have another problem to deal with, that being the monsoon, with both SkyMet and IMD predicting a normal monsoon. So there are a lot of concerns on the fundamental side. So it's better to just kind of wait and watch. We have a very good earnings season coming into play, and better to look for winners after the earnings season is over, depending upon what the managements have to say as to how they are managing the current challenges around the geopolitical event and what the impact will be there of a poor monsoon.
Got that. So no churn in your portfolio just to get out of some stocks which might be negatively impacted to create the position to add fresh ones post the earnings season?
No, not really. I think let's see what happens in the earnings season. There's always a great deal of stock-specific volatility before and after the numbers are announced. And then there's the management commentary as well. And typically, I feel that this is a good quiet period for investors to, just reflect and then see what the companies have to report. Every time a company reports an earnings, you tend to reassess its forecasted earnings per share and its business prospects, any challenges, any opportunities which have opened up, and leave the kind of powder dry for something interesting or surprising which may come up in this earnings season.
So do you want to share some of your reflections? I know in the last two interactions you spoke about energy security and that entire value chain is attractive to you. But outside of that, do you want to tell us some themes which maybe you'll wait for confirmation to come through post the earnings season and the commentary, but some themes which you think might be interesting and worth watching?
Yeah, I think that, rupee at around this 93, 94 is a reality. It's going to remain at these levels and gradually depreciate by 2-3% every year as it has. And I think it's time to look at exports as a good investment theme, not just software services, but could be textile exports, could be machinery exports. There are so many new listings of companies which are engaged in kind of capital goods which are into the export market. So that's one thing which I think requires a lot more study and insight. And certainly their competitive strength would have improved because of a sharp depreciation in the rupee. Similarly, I think import substitution also could be a good investment theme. So that is a new kind of a thought process which we are running through. So this earnings season, we'll try and check the impact of these kind of rupee rate versus what the business kind of offers if it is export oriented.
Okay, all right. Deepan, I want to ask you about some of these cement names. I recall a few months ago you were actually getting a little bit constructive. Now the verdict is split down the middle because they had a good start to the year. But unfortunately, what happened was in the month of March, we have input costs that have gone up, coal, pet coke as well, and that will hurt, say, in this, by May or June onwards. In the near term, though, these companies are taking price hikes and some part of that is getting absorbed. Nuvoco came out with their numbers. Anything you like from this space?
Yeah, I think that cement is a great long-term play, and you will get volume increases. And I think that there's certainly a certain amount of price discipline as well. The top pick still remains Ambuja Cement because of the consolidation with ACC and Sanghi already has taken place. So it becomes a larger and larger entity. And there's certainly scope for A, synergies, and B, improving the efficiency, especially when it comes to the ACC cement plants. So I think that there's a bit of an opportunity over there. It is trading cheaper than some of the other large cap cement companies like Ultratech and Shree Cement as well. So there could be a good, I would say, trading opportunity, invest opportunity in Ambuja Cements itself. So that's where we remain quite positive. And yes, I continue to maintain a constructive position in cement because I think these increases in pricing of raw material could be transient if the war ends quickly. If not, they have shown in the past that they can certainly pass on cost increases. And I don't think that the increase in installed capacity, the expansion across the industry, is going to cause as much damage as I feared earlier. Because earlier companies were announcing expansion left, right, and center, but now I think those kind of announcements have got tempered down. So from that point of view, I feel Ambuja Cement certainly looks very interesting. But of course, I think if you have investments in Ultratech or even Shree Cement, I would remain invested over there.
Deepan, stay on. We just want to quickly talk about the consumer space because IMD has predicted a below normal monsoon, and this is the first such April forecast in several years. So IMD is now saying that for this season, Rainfall will be 92% of the long period average, and this follows SkyMet, which has predicted a 94% forecast for this season. So it's important because it raises concerns for kharif crops, water reservoirs, rural demand, potential inflationary pressures on food items if the deficits materialize in key agricultural regions. To talk more about it, we have with us Manoj Gauri, Associate Director of Equirus Securities, and we'll also talk about the consumer durable space and whether the AC, the AC sales have materialized to the extent that the companies were hoping for. Manoj, thank you very much for joining in. First, do you want to quickly comment on if monsoon is below normal? Which stocks are likely to be most impacted? Which ones do you have in your coverage? And are companies prepared?
Yeah. Thank you for having me on the show. See, if you look at the monsoon-related or probably if you look at the summer-related stocks, I think they should benefit significantly from the below normal monsoons. Even if you look at what we have started to see is in past few days when the temperatures have started to rise, we have seen sharp uptick in demand, especially if you look at from the southern markets, which was underperforming during the month of March. So if you look at from our coverage, we cover most of the consumer durable names today. We believe like AC name seems to be better placed along with air cooler names, because once what we have seen is when the demand probably continues to remain strong, if we see normal summers and probably temperatures being supportive enough.
So AC sales have materialized as expected in the month of April, because I remember chatting with Blue Star very recently, and he had given that analogy. Like, sales have been impacted on account of a delayed summer, the price hikes, war-related sentiment. So he said that it's like a power play where the first over has turned out to be a maiden, but we're still very hopeful of a 20% kind of a growth. Yeah, go ahead. In terms of the room ACs and the cooler segment, the kind of growth that we've seen in April, and what should we expect for the entire season?
See, if you look at in the month of March, Kerala and Tamil Nadu markets were significantly under pressure, where Blue Star is relatively strong. But what we have seen in past 8 to 9 days, once we have seen those unseasonal rains are behind us, there has been sharp uptick in demand. Today, if you look at the best performing market in South would be Tamil Nadu, Andhra Pradesh, Telangana, even Karnataka, which is normally perceived to be a very pleasant city. There we have started to see very strong demand from a city like Bangalore. Now, if you look at Kerala, which witnessed sharp decline in sales in the month of March, even we are seeing growth during the month of April. So within a span of 7-8 days, if you look at, things can change very quickly for the cooling product categories. It just needs 3 to 4 days for the consumer to feel that heat. And it will be an impulse buy for the consumers when you look at that the temperatures are supportive enough. And today, if you look at in many parts of the country, including cities in states like Gujarat, South, we have started to see temperatures being more than 40 degrees today.
So what's the expectation for the sales for this summer season for the room AC, for the room AC manufacturers?
See, what we have seen is last year, if you look at, I think the best part for room AC players is if you look at financial year FY26, we have seen 10 months of decline at primary level of the 12 months. It was only in the month of December and March where we have seen primary sales actually reporting growth. We are sitting on an extremely favorable base. Now, what we are seeing is when we speak with some of the larger channel partners, they continue to maintain their view that this year 15 to 20% secondary sales growth in volume terms seems to be very much possible. So your primary sales growth is likely to be higher than your secondary sales growth. And further, if you look at 10% of price hikes already taken, and we expect another 2 to 3% price hikes somewhere around April end. So the growth outlook for room AC continues to remain very strong for now.
All right. Hi, Manoj. Good morning. Good to see you in. Manoj, you got some data points with regard to the month to date. What has been the growth so far?
See, if you look at for this month, for the month of April, we have started to see roughly around 25 to 30% growth in southern market.
Okay.
If you look at from the west point of view, it's close to around decline of close to around 13 to 14%. North is a decline of close to around 12 to 13%. So we are very close to that, roughly around -3, -5% kind of growth. Also, one thing what we must also see is from 13th or 14th of April, the favorable base starts, where last year we started to see unseasonal rains from roughly around 13th or 14th of April. So probably when you look at in next 1 week, we'll be able to cover up the decline that we have seen for first 10, 12 days of April. And then in the last 7 to 8 days, we'll be seeing a growth. Somewhere we can see 10 to 12% growth in the month of April in volume terms.
Yeah. By the way, that Kerala point, Blue Star Management, Mr. Jagarajan was with us. He did mention that Kerala perhaps numbers are pretty poor, but it's gotten really hot, I think, very quickly over the last 5-7 days. And temperatures are soaring. And as Manoj is saying, things looking up for these AC sales. Manoj, I don't know if you have coverage on LG India?
Yes, we do cover.
Your thoughts here, and how are valuations looking? I mean, didn't do anything after listing. Is it? It's more diversified in its portfolio and offering, right?
Correct. See, I think LG, if you want to play the Indian home appliance story, I think LG is one of the best names to have in your portfolio. From pure play season point of view, from summer sales point of view, room AC names will be better placed. But if you want to play a long-term Indian home appliance story with a well-diversified portfolio with market leadership in most of the product categories, I think there is no other better name than LG. And probably if you look at the way a company has progressed in last 3 to 4 years, it has been a remarkable journey, especially when you look at the premiumization story that is getting played out for LG as of now. So if you look at in valuation terms, definitely LG seems far more attractive. But on the other hand, if you look at the growth rates that one can assume for AC names on a CAGR basis, LG is likely to report relatively lower growth rates as compared to AC names.
Yeah, no, absolutely. Cooling is going to be the #1 source of power demand in the country for many, many years. Most studies show that. So AC is perhaps top-selling consumer durable item in that sense. Just a quick word on Whirlpool. I don't know if you have a view. Once in a while, one hears about that name. And you know, right, what it's the promoters sold. I mean, the global parent is sold, and maybe they'll sell more, or I don't know how much there is to sell. But your thoughts?
See, Whirlpool, if you look at, I think the market share probably they have regained largely all the lost market share. Currently, their market share in refrigerator would be hovering around 18-19%. At peak, that was close to around 20.5%. They have done a good work, especially on the market share regain, not only on refrigerators, but even on washing machine. However, if you look at both these categories, especially the refrigerator, the category itself has been struggling and pain is more on the entry-level segment. Secondly, if you look at the Whirlpool Corporation selling its stake, and if you look at still, there is a lot of stock which will be coming into the market, there will be supply. So probably we believe stock may continue to remain under pressure. But if you look at in the near term, at least till the consumption actually improves at the ground level, which would be a broad-based recovery, till then we expect Whirlpool to relatively underperform versus peer.
Got that. Manoj, lovely chat. Thank you very much for joining us. Appreciate your time here on CNBC TV18. All right, well, just take a quick commercial break here. There's 15 minutes to go for the pre-open session to kick off. We'll be back, and we are going to get in Deepan Mehta for more market conversation, Sudarshan and Mitesh for some trading ideas as well. Stay tuned. Okay, welcome back. The big buzzers from yesterday. Hormuz is here with that list. Hormuz, good morning.
Morning, Prashant. And yes, there was a long list of movers in yesterday's trading session on the upside. Starting off with some beaten down names, Railtel was one such name. The stock was up almost 16-17% in yesterday's trading session. It's the biggest single day move since March of 2021. And it has gained in 5 out of the last 7 trading sessions, yes. But yesterday's volumes were the sum total of almost the last 48 sessions put together. Close to 7 crore shares were traded yesterday for Railtel. That was the highest since July of 2024, and that was comparison to the 20-day average, which is only 13.5 lakh shares. So out of those 7 crore shares, only 4.5 lakh shares were shares were marked for delivery, which means around about 31 lakh shares, and that too is significantly higher than its 20-day average of around 4 lakh shares for Railtel. The stock, of course, has been a beaten down name from its 2024 peak, which is well over 600 rupees. The stock is still down almost 50% from those levels. The one big mover yesterday was Grow, and the new listing. The stock has now doubled from its issue price. The 5th straight day of gains now, and in the 9 trading sessions that you have had in the month of April, the stock has declined only in one of them. And the month of April so far has seen the stock gain almost 40%. So from levels of 150 odd, which it closed the month of March, it is now at 210. Yesterday's volumes were the highest since the 1st of Feb. The 13 crore shares were traded. Compared to 20-day average of close to 3 crore shares. The delivery volumes were the highest since the 1st of Feb. Trading volumes were the highest in 3 months. 2 crore shares marked for delivery, 20-day average of close to 80 lakh shares. The third most traded stock on the Nifty 500 yesterday, and is the best performing stock on the Nifty Midcap Index as well. And lastly, Dixon Technologies, the stock closing above the mark of 11,000 for the first time in almost 2 months, and is gained in 5 of the last 7 sessions as well. 8.5 lakh shares traded yesterday, above its 20-day average. Close to 30% of those shares were marked for delivery as well. That too is higher than its 20-day average, and from its 52-week lows of the 30th of March, which is close to 9,600 rupees, the stock has seen a rebound of close to 16%.
Okay, all right. Thanks a lot for that, Hormuz. Well, going back to Deepan Mehta. Deepan, yesterday you had all these market-related or, these market-focused stocks that did do well. Case in point being the exchanges and brokers. You had Grow that did pretty well. Motilal Oswal was up and about as well. Even the depositories did well. From this entire basket, what do you like, in terms of a theme? And further down into stocks, what do you like?
Yeah, sorry, Nigel, I just got disconnected for a minute. Is the question on capital market stocks?
Yes, on stock marketplace. That's correct. Either brokerages or the exchanges, various other platforms.
So I think, according to us, the best pick still remains MCX, and that also has been touching new all-time highs. And the reason for that is that the kind of volume and volatility which we are seeing in gold and crude oil certainly benefits MCX. And some of the threats related to some of these larger capital market players as regards options, that is a bit less in MCX, although MCX option volume is what is driving the earnings growth at that company. But this is one company which I would rate as the top pick within the sector. Also, we like a lot of these wealth management companies. We saw the results which came from Anand Rathi Wealth Management. I think we can expect very good numbers from 361 also, as well as Nuvama also. All of these 3 companies have got solid annuity revenues. So even if there is fluctuation in stock market prices, so the annuity revenues provide a great deal of stability to their earnings. So that's the way we want to play these companies. I know that BSE and Grow have all done very well, but end of the day, compare the valuations, compare the cyclicality which is there in the business. I would just say that the risk return doesn't favor you.
Yeah, risk reward. Return does not favor. Deepan, this STT hike, right, which is coming to place on the 1st of April, I'm assuming because of the volatility, and there's been a fair bit of swing in volatility because of the Iran war and the headlines and the tweets and whatnot. But once all that kind of fades away and becomes a more normal kind of market, I'm assuming this is going to take a bit of a bite, right? It's a pretty significant increase especially on the future side in terms of market depth, etc.
That's right. I think we are still not able to see the full impact because, as you said, the volatility is taking care of some of the volume which is coming through. But end of the day, it's certainly going to impact a lot of brokers. But I don't think the listed brokers will get impacted as much. It's more the prop traders which are getting affected. And there we are seeing that their entire large teams of options traders are not able to generate the returns for them. So that's going to be a bit of a problem. But specifically for the listed companies, be it Grow or Motilal Oswal or IIFL, some of these companies, I don't think they are engaged so heavily into prop trading. But yes, I think that the number of traders making losses in derivative remain very, very high. So that always is a risk factor, as is any regulatory intervention to curb F&O volumes, and that could affect all the listed companies, including the exchanges, and even NSE, which is planning a very kind of a IPO at this point of time.
Got it. Okay. All right. Deepan, thanks for that. Well, let's of course to Sudarshan. He's here to tell us about some brokerage calls of the day. I think the focus is on auto stocks and renewables. Sudarshan, looking good in pink.
Good morning, Nigel. So first one, there is a very interesting note from the MK has come on the auto sector, and they are saying there can be a mega shift towards electrification in the auto sector, and they have compared the shift that we had seen in 90s from scooter to motorcycle, and they believe that it can be similar as far as electric vehicle is concerned, and for them, Ather is looking well placed to ride this theme. And they say any potential fuel price hikes post-state elections could accelerate the shift towards electric vehicles. And as far as penetration is concerned, in FY26, electric two-wheel penetration was 6.5%, which has risen to 8.6% in the last 4 months. And it continues to like the electric two-wheeler theme and prefer to play with Ather. They have raised their estimates for both FY27 and FY28 by 2.6% and 4.6% respectively, and maintains buy call as increased target price to 1150 from the earlier target price of 1100 rupees per 1000 rupees per share. And amongst all the other players, they are positively biased on TVS Motor. Another note is Jefferies on renewables. They believe energy security focus is rising due to geopolitical issues, and renewable energy capacity of India by FY30 it's going to increase to 360 gigawatts, and also power demand is going to recover to around 6% in FY27, and El Nino can be another tailwind. As far as top picks are concerned, JSW Energy and NTPC, they are also positive on Premium Energies and ME Photovoltaic.
Sorry, which are the two companies on the renewable side? JSW Energy is one, the other two, Sud?
So JSW Energy, NTPC, Premium Energies and ME Photovoltaic.
Okay, got that. Thanks very much, sir. So that's autos and a bit about power on the renewable side, more specifically. We'll take a break, come back the pre-open session in about 4 minutes. Mitesh and Sudarshan with trading ideas as well. Stay tuned.
Welcome back. The Nifty yesterday closed above the 24,200 mark, having staged a powerful rebound. And from the lows in the early part of April, the Nifty is now up 2,000 points. Where do we go from here? The GIFT Nifty is suggesting a 100-point gap up opening. Mitesh Thakkar, Sudarshan Sakhani, as always, are joining in. Gentlemen, good morning. Sudarshan, if we do have that gap up opening, we will be closer to resistance levels of 24,300 and slightly above that. So what should be the trading approach?
Good morning. Well, if we do have a gap up, then the trend which we identified earlier continues to exhibit itself. So the trend is on the upside. I had suggested that traders should take profits yesterday and keep a core positional trade going on till this momentum continues. So you should be having a core positional long which you do not disturb. For the trade today, I do not think this position today is a good idea to trade unless you get a sharp dip, which is unlikely. So today or tomorrow or Monday, maintain a positional long, look for opportunities to buy only if you get a 200, 250 point correction, and that we will get in the next 2-3 days.
Okay, all right. Got that, Sudarshan. What about you, Mitesh? How do you approach trade? You're just pointing out earlier that the broader markets actually seem to be doing much better than the Nifty because they're trading above the February 27th levels when, in fact, this war broke out. First, tell us your take on the Nifty and then we'll focus on stocks.
Good morning, Nigel. I've kept a positive bias in the last few days, and have talked about targets of 24,300, which was nearly met yesterday. We got a high of 24,280. Now, when the markets were falling, there was this gap down on the between the 6th and the 9th of March, which has a pivot around 24,300 to about 24,420. So I think that becomes a first hurdle, and you will expect some strong supply around these levels, and it will take some effort to get past. But eventually, I am looking at a good chance, a possibility of us heading towards 24,800, 900 on the Nifty. That's the zone which I'm eventually targeting. So from a trading point of view, I think, and I've maintained this, that traders should be nimble. So try to take some profits at 24,300, 400 zone. And only once the Nifty stabilizes above this level, then I think take fresh long positions, or you will get a dip to buy into, because this is still a very news flow driven kind of a market, and therefore volatility will be on the higher side.
Indeed, still trading the headlines. It's just that the headlines now are a lot more optimistic about hopes of another round of talks and negotiations. So, Mitesh, what would be the stock calls for the day?
On the stock side, I have all buy-side calls. Buy on Glenmark with a stop at 22.29 for targets of 23.20. CG Power, I think, made a fresh swing breakout, so that's a buy. Keep a stop at 734, look for targets of 775. A buy on DLF with a stop at 573 for targets of 615. And GMR Airport is the final buy call. Keep a stop below 97 here, look for targets of 104.
And Sudarshan, your stock ideas?
It's also an all buy list. SBI Card is a buy with a stop under 670. RVNL is a buy with a stop under 280. UNO Minda is a buy with a stop under 1080, and finally Lupin is a buy with a stop under 2300. As you just said, that the mid caps and the small caps are doing well, so keep a core Nifty position and focus on these this segment, small and mid.
Okay, gentlemen, thank you very much for those ideas. We'll come back to you and get in your 9-10 calls. For now, let's put the spotlight on ICICI Lombard. Yash joins in with the numbers.
Well, for ICICI Lombard in the fourth quarter, it's a top-down beat from premium growth to the underwriting performance. As far as the gross written premium is concerned, that saw a growth of 17% on a year-on-year basis. The net earned premium also saw a growth of 11%, but more importantly, the number on the net earned premium was 5790 crore, which compares to a pool of 5731 crore. So it was much ahead of street estimates. As far as the underwriting loss is concerned, that came in at about 282 crore rupees versus 210 crore rupees, a minor jump, but the street was anticipating a number of close to about 350 crore rupees, so much lower than what the street was looking at as far as underwriting loss is concerned. Operating profit, the number came in at about 546 crore rupees versus 571 crore rupees. The street was only anticipating a number of about 171 crore rupees, so much higher in terms of operating profit. Finally, combined ratio, that number came in at about 101.2 versus 102.5. So improvement of about 100 basis points on a year-on-year basis. The street was expecting a number of 102.69. So it's an improvement from the levels that the street was anticipating, also a top-down beat for ICICI Lombard.
Okay, Yash, thank you very much for that. Pre-opening rates are coming in, and it's about 160 points up on the Nifty around the 24,380 mark. We should pull up Asia as well because they're trading with strength. The Japanese market is up 2.5%, the Taiwanese market and the Shanghai up about 0.5 to 1%. Korean markets are surging 2%. China Q1 GDP data was also out a while back. It's come in at 5%, ahead of Bloomberg consensus of 4.8%, and it's tracking at the upper end of the country's own forecast of 4.5 to 5%. So Q1 GDP at 5% for China is positively surprising, and that's kicking off things well for the Asian markets as well.
I think the pre-open here, right, 4 minutes in, the rupee is also starting slightly stronger, 10 paisa stronger, 93.28. compared to 93.37 or so where we left off yesterday. Well, I think we can welcome in Prashant Jain, who is now with us, founder and chief investment officer at 3P Investment Managers. Prashant, good morning. Great to have you with us here. Appreciate your time. And Prashant this side. Good to see you. It's been a while.
Good morning, Prashant. Pleasure.
Has the market turned, Prashant, in your opinion? And I will tell you, I was speaking with a fund manager who said, well, I'm confused. How should I position myself? Should I position myself a little more aggressively, to capture upsides, sustained upsides, or this is again going to be, up and down and up and down? So what's your sense, Prashant?
I think I'm quite optimistic about the resilience of India, about the ability of India's economy to handle the spike in crude prices and disruptions. India is far better positioned this time around because our current account deficits are structurally lower, and the impact on the economy there should be commensurately moderate. And even our capital markets, while foreigners are selling, there is no supply or very little supply from the primary markets. And the domestic flows, I think, should not just hold, but they should grow over time. And therefore, the ability of markets to absorb this FII selling is quite good. And over time, I think investments made around this time should yield above average returns.
Yeah. Prashant, you must have seen, right, a lot of sort of hullabaloo on social media and elsewhere around the question of why foreign investors are selling. And recently, right? And Akash Prakash wrote a piece recently, and he outlined a list which is, global. Some of the global Asian peers are more attractive. Here in India, earnings growth has slowed down. None of the it's not new. Nothing is new. ROEs, he mentioned, perhaps have come off as well. In your opinion, have some things changed in terms of things which were always structurally positive for India, which is higher rates of growth and better earnings profile, return ratios? Has that suffered a little bit in any way whatsoever, Prashant?
On the contrary, India's growth is accelerating, right? You are growing at 7%, back-to-back second or third year. So when have we done that in the past? India's bank balance sheets, corporate balance sheets are in the pink of health. Your current account deficit is near 1%. Your fiscal deficit is quite reasonable. I think India is quite well positioned. The fact remains that 2 years back, India's premium over EMs had gone up to much above average levels. And also, I think the earnings were overestimated. And we have been of the view that for last 2 years, that earnings growth will converge with the nominal GDP growth of the country, maybe slightly higher than that. Because in most sectors, we do not see any margins improving. And from the COVID lows, the margins normalized, they improved. And therefore, it was wrong to extrapolate that earnings growth. I think there could have been some earnings disappointments, but that's more to do with probably slightly aggressive estimates. The selling of last year, I think, also had the shift towards AI, the popularity of AI. I think clearly that was not in favor of India because India does not have, or it lacks, meaningful AI plays. In fact, IT is looked upon by some, I don't agree with that, as an anti-AI play. So, and finally, last month, I think this spike in oil, the fear of even higher oil prices, and the fear of sharply lower currency, which would hurt foreign investors a lot more. I think that has led to this last round of selling. So we have had 3 back-to-back, one slightly longer term, one last year and one this. I think this, whenever the situation stabilizes, the foreign outflows should stop. I must also add that it matters little now at how foreign flows are for the markets, because the bigger source of supply in these markets was the primary markets. Investors have lost money in 2 out of 3 issuances. So I think those excesses are behind us. That supply should be sharply lower, and therefore the ability of markets to absorb any FII selling is quite strong. See, foreign selling can delay returns, but I don't think it can deny you the returns. The returns will eventually come.
So you're saying three things. One was earnings being systematically overestimated, basically projected that the COVID boom and coming. I mean, that basically will go on forever, which was wrong. AI related. Lack of AI plays perhaps attributed to some of the selling, and this oil shock, right? Is this one. And you said, well, although foreign flows in that sense for longer term returns matters little, you said that will also change once the situation stabilizes. Prashant, you for the last, I think, 15, 20 years, we've spoken, always mentioned oil on the top of the list as worries for India, as one of the most important macro factors for India and the markets. It's around $90, $95. I mean, how do you assess that situation? If it stays here, as many say, it may.
I think India's vulnerability to oil has considerably moderated because oil exports as percentage of GDP have fallen from 5% maybe 10 years back to about 3%. And to that extent, you have a lot more room to absorb higher oil prices. India's current account deficit also has fallen from between 2 to 3% in the past to around 1%. So your ability to absorb higher oil prices is therefore much higher. See, please remember that 10 years back, India used to fund its current account deficit at times from portfolio flows. Today, you have lost more than $10 billion in a single month, $40 billion in maybe 16 or 18 months, and still your economy is growing. Markets are holding up reasonably well. And the correction in the markets is, as much due to excessive valuations, as much as it is due to the excessive fundraising, and foreigners have also played a part. But the flow of local capital is much larger in size than the inflow or outflow potentially of foreign capital. It is true that foreigners still have a reasonable amount of stock of India, but on a flow basis, it is the local capital which is much larger and far more sustainable.
Just one last question from my side, Prashant. We spoke at that Kotak event, and at that point you'd said, talking about the local flows, you said, typically, in your experience, it is year 2 or year 3 of no returns when local flows start to panic a little bit, right? 3 years of kind of flattish returns is when that starts to happen. You need to worry. So far, we've not seen that. What is your sense on that question? And it will be 3 years this year, right? We closed 2024 at 23,600. We are at about 24,200 today. So just your sense, Prashant.
What I had said then was that in my experience, when the industry was far less evolved, when investors were also far less evolved, in my experience, that could be maybe 15, 20 years back, when 3-year returns turned negative, that is when SIP started moderating. I think we are only 18 months into this correction, and it would be very realistic to assume that for the next 18 months, you will not make money. So I remain quite optimistic on domestic flows, not just sustaining, but even growing. On the other hand, the tax laws have changed in the country. And today, the gap, post-tax gap between fixed income and equities is much higher than it used to be in the past. Because in the past, there were instruments where you could invest in fixed income at sharply lower interest rates. And of course, the awareness, the education of investors in India has gone up exponentially over the last 10, 15 years. So I would guess that this flow should not just sustain, but should actually grow over time. I think in India, even today, less than 10% of gross household financial savings are being invested in equities. That number in most markets is somewhere between 20 to 40%.
Yeah. Prashant, just give us 30 seconds. We'll just look at market open, and then we'll come right back to you, and we'll continue this very interesting conversation. We've got, 0.6% higher start, and 24,360 is where the Nifty is at. The Nifty Bank up about 0.75%. We got the mid-cap index and small-cap indices. I don't think we got a rate yet in the small-cap. That 2% is from yesterday's close. We'll have it shortly. Mid-cap index is starting 3/4 higher. The small-cap index, of course, is also about 1% higher at this point. So, it's a pretty good start, and market breadth right out of the gates is very, very healthy, very positive. Some 15:1 in favor of advances is what you've got going. And yesterday was a case in point. Really wide variety of mid and small caps from across the board sectors with volumes doing very well. So let's see if we get a repeat today. Adani Enterprises, L&T, ICICI Bank, that's a nifty heat map in terms of where stocks are opening. I think you've got about 40 names which are higher, 10 stocks which are opening lower. Coal, HUL and SBI Life are down. Everything else is in the green. About 120 points, 0.5% on the Nifty. Rima.
With the advanced decline ratio standing at 14 stocks in the green for 1 in the red. Okay, 10 stocks in the green for 1 in the red. We've got about 2,000 stocks advancing for 200 stocks currently on the red side. Sector staging the biggest rebound today is realty. That index is now up 20% in the month of April. Then you've got defense, which is emerging as a structural theme. Defense is up 1% for the day and 20% again since the start of the month. IT is also holding up well. Wipro reports numbers post-market hours, and along with numbers, the street will track the buyback quantum because the board will be mulling that. So these stocks are opening up in the green. The big gainers include Adani Enterprises, that's up 1.5%. Eternal is seeing buying. Many of these aluminium names were higher yesterday. So whether it's Hindalco, Nalco, these stocks continue to see buying today. ICICI Bank is the big mover in the large cap banking names. Along with that, HDFC Bank also higher by 0.7%. Interglobe Aviation sees buying. Crude prices continue to remain stable, just under that $95 per barrel mark. Consumption names like Trent in the green. BEL is a big mover. On the way down, Coal India is subdued. ONGC down about 0.5%. Again, I can't see a single Nifty stock with a cut of more than 1%, and that gives you a sense that broadly, overwhelmingly, the sentiment in the market is positive. Reliance Industries has moved into the red. You've got a little bit of red for Bajaj Auto, Apollo Hospitals, but the gains are very, very minor. Up 140 points on the Nifty. Mid-caps outperforming now. Mid-cap index surging over 1%.
From the broader markets, I think the result reactions are calling for attention. HDB Financial Services, the stock is up close on 10%. Street reacting very favorably to those numbers. Big uptake on that particular name. On the flip side, you have Tejas Networks that open gap down 5%. But I think the street was not expecting anything great to come out of there. So let's see whether or not that dip has got bought into, because there has been some kind of good news that could play out for the remainder of this fiscal year. Let's see how that goes. For the time being, the stock is down close to around 4%. Suraj Estates, a stock that's seen a sharp correction from the top. They have acquired land with the potential of 100 crores of GDV project in Dadar West. And for the time being, the stock is up close to 10%. But keep in mind, the stock is half from the peak that we saw. Gallant Ispat, another stock that's been running along. For this week, the stock is up 30%. For the month, it's up more than 50%. We've done a quick analysis. It's valuation-wise, it's quite expensive. But they have some kind of expansion plans as well as backward integration that they're talking about. So for the time being, the stock has spiked out. Remember, there's no institutional holding on this name as well. Other stocks that are moving around on reasonably high volumes, IRDA, IREDA, pull up that stock. Volume's quite large on that one. Stock is up close to around 3% as we speak. So big move on that particular name. Net, a good start to trade. The mid-cap index continues to outperform. The breadth of the market, 10:1. We're getting a little used to seeing these sort of, a number of stocks advancing to declining stock. But remember, in the month of March, it was totally the reverse of that. So good start, building on from here, crucial. Prashant.
Okay, let's continue our conversation with Prashant Jain. Prashant, hi, Rima here. So one of the guests we were speaking to earlier said that this is a themeless market, which basically means that we're going to have winners and losers in every sector. There is not going to be one or two sectors where everything does well, a rising tide lifting all boats kind of a scenario. Would you agree with that? And if you do believe that there are structural themes where one, can bet on, which ones would they be?
Rima, good morning. See, my view is that what we have observed in this market over the last 5 years, that excesses at both the ends have moderated. So you go back 5 years or 4 years, some consumer names were trading at 60, 70, 80, 100 P multiples. They have since moderated to maybe mostly around 40 multiples. Similarly, on the other hand, there were stocks in few banks, utilities, etc., which were trading at maybe 4, 5, 3, 7 P multiples, and they have defense names for around 5, 8, 10 multiples. they have re-rated upwards to anywhere between 10, 12 for banking to maybe 20, 30, 40 for the other names. So I think I would agree with that comment in a way that the excessive valuations are not there in this market. And most sectors are trading around longer term average multiples. So it would be tougher to call out specific sectors in this market. And therefore, we have been writing in our commentaries also that a more diversified approach to investing makes more sense in this market than a sharply focused approach on few sectors.
Okay, hi Prashant. Good morning and good to see you in. This is Nigel on this side. You're sounding reasonably optimistic post the correction. But the space that got hit harder actually was the broader markets, the small and the mid caps. You know, we talk about the index not giving any returns. People are sitting on portfolios where they're down 15, 20, 25% as well, depending on, which stocks you bought. At current juncture, what would your preference be between the large as well as the small caps? Because yes, they've seen a sharp correction. The froth has cleared out a little bit, but still valuation-wise, not very cheap.
Well, Nigel, I would agree with that view. And we have for almost 2 years been suggesting that small mid caps have run much ahead of fundamentals. It is, in my opinion, an incorrect notion to say that as a category, small mid caps grow faster in businesses than the large caps. I don't think data suggests that. Even today, if you look at the share of small and mid caps in terms of profits of corporate India, it's about 25%. But their market cap share is much higher. So I would not be optimistic on this category. Of course, they have fallen so much. 1 in 3 stocks is down more than 50%, I think, from the peaks. So there can be a sharp bounce, but as a category, I would feel that large cap should outperform. At the same time, since the stock has seen sharp corrections and the number of companies in this space is very large, I think it should be possible for someone to pick 1 in 10, 1 in 20 stocks. I think it could be a stock picker's market, but not across the board. One will have to be extremely selective and careful.
Got it. All right, Prashant. So you're saying large over small caps, but within the broader markets, you still find select winners. So you need to keep an eye out for that. Prashant, you've spoken about the fuel price inflation and how India is reasonably in a better space, say, in comparison to, say, 15, 20 years ago or so, because of the expansion of the base of the GDP. But what about the food inflation worry? There is talk that maybe, in fact, after many, many years, this monsoon may not be that good. Is the market ignoring that risk?
See, there is a difference between inflation in food and energy and inflation in other categories. Food and energy inflation is not due to excessive demand conditions. These are, either because of natural factors or global commodity price changes. So I think the RBI will not set the monetary policy based on food or energy inflation. RBI worries about inflation when it is more demand-led or when demand is more than supply. So I would focus on the core inflation, which continues to remain extremely benign. It's ruling around 3%. So I think it's a very healthy state of inflation in India.
Prashant, talking about, and just to complete that earlier point about mid and small caps, right? I guess it's a bit more, if I can use the word, for the lack of a better one, more exciting in people, mid cap, which is the small cap, which can become the mid cap. Mid cap is a much more tougher area as well to operate in. So you're just to summarize your view, as a category, you're saying perhaps large caps have got more room to grow earnings, and mid and small caps, while prices have fallen, there may be opportunities here and there, but as a category, you're more constructive on large caps from here. Prashant, is that correct?
I think, Prashant, that is correct. And the gap that is opened up between valuations in large and small mid caps as a category, in my opinion, it is not sustainable. And that gap should be bridged over time. Yes.
Okay. Got that. Just to address another point, Prashant, which is supply from local investors, right? And something that you addressed earlier as well. And you kind of sort of, went back and gave examples from the 90s and early 2000s and said how this is not going to last. And we're already seeing that it's not working out all that well. I mean, on the private side, huge amounts of investments have happened. A bit of a chase, a FOMO feeling, etc. Generally, are those excesses also coming to an end? Have they already come to an end? What is your sense?
No, Prashant, you're referring to the unlisted markets.
Unlisted, and of course, I mean, you throw in some of the higher priced IPOs, etc. as well. Prashant.
I think that's fairly clear. See, 2 out of 3 shoe answers in the last couple of quarters are underwater. People have lost a lot of money. This is not the first time. I mean, we saw this in early 90s. We saw that in 2000. We saw it in 2007, and we saw it yet again. I don't think this is surprising. It happens every now and then. I think for now, the markets would be far more cautious on pricing and on what they are buying. So I think primary markets are essential for an economy to grow. You need to give capital to entrepreneurs. And it also keeps secondary market prices in check. But if that capital is raised at sensible valuations, it creates a win-win. Otherwise, it gets disrupted. I think it will normalize over time, but I don't see those excessive times coming back anytime soon.
Got that. 2 questions. You mentioned briefly AI. What is your sense? I mean, in the West, for example, we saw that before the Iran war took over all the headlines, that this entire AI, quite all these product releases every day was kind of sort of taking the air out of one sector or the other, and questions about terminal value across businesses, not just software, but I mean, across a range of businesses. How big of a question of that is that here in India, Prashant, in your opinion? And how do you think about that AI question?
And I think, see, we are all learning, and at least I am not an expert on technology. So we are also evaluating this, learning this as we go along. But my view is that AI will be a productivity enhancer for most businesses that will adopt AI. So I think it should be positive for economy, for productivity, for everyone in general. I also do not completely agree with the narrative that the AI industry, the IT industry, will suffer deeply because of AI. My view is that, yes, AI will enhance productivity. So what was being done in, let's say, $100 may get done at $70, $80, or $90. But to that extent, cost will also be saved. But the real issue is, everyone agrees on productivity gains. The real issue, however, is, will the customer save the $10, $20, $30 of productivity gains, take it to their balance sheet, P&L, or will they spend on something that they could not do so far because of budget constraints or because of adoption of AI or new technologies? My view is that enterprises adopt technology in a slow and gradual fashion. And if you leave aside the tech companies, tech companies can adopt AI on their own. But when you talk of non-tech companies, let's say banks, engineering companies, retail companies, media companies, they will need the hand-holding. They will need the services companies to handhold them into adoption of AI. So I think over time, in my opinion, there is a fair chance that this actually becomes a tailwind, the adoption of AI by enterprises for Indian IT companies.
Yeah.
The challenge is that similar companies outside India, the equivalent of Indian IT companies, are trading at much lower valuations. And that, I think, would be a headwind for some time for the Indian IT companies, because foreigners would rather buy these companies outside India than participating in India.
Yeah, no, well reasoned, Prashant. And wonderful getting your insights as always. A range of topics we've managed to cover here today. Thank you very much, Prashant, and hope to see you again.
Oh, thank you, Prashant, Rima, and Nigel. Thank you.
Thanks very much. All right. Well, that's an exhaustive conversation from one of the top, fund managers here in India with one of the longest track records, stellar track record, really. Well, let's just talk about the sober news which we got from last night, which is veteran investor and emerging markets pioneer Mark Mobius passing away at the age of 89. The veteran investor spent more than 30 years at Franklin Templeton. I mean, it speaks to what he did for emerging markets, that when he started at Templeton, I think the assets under management were about $100 million on emerging market side. When he left, that number was about $400 billion. He was a strong advocate for investing in EMs, developing markets, and really on the ground author of several books. And of course, a regular here on CNBC-TV18 as well for 26 years. He's been part of many big events that we've held. And of course, our heart goes out to his family, his team, and he will be missed. Really, someone who was a big bull on India, unwavering, really. A slice of some of the conversations we've had with Mobius, of course, will not do justice to everything we've done with Mr. Mobius over the years, but just take a listen.
That AI has been pushed and pushed and pushed by so many people that it's quite bubble-like territory. But at the same time, you must remember that AI is here to stay and is expanding. More and more people are adopting AI systems. I myself, I'm using AI almost every day. So there's no question that the AI revolution is here to stay and will continue. But some companies have been emphasizing their AI expertise, and that really may be a little bit too much. Some of these companies are not really into AI directly. And so I think we have to watch it and pick and choose those companies that are really into AI systems and developing AI. And you must remember that in addition to the software, there is the hardware, the chips, which is very important to develop AI. As you know, the bureaucracy involved in entering India is very, very complex and difficult. Now, as that begins to fade away, as the Indian government begins to loosen these restrictions, you're going to see an incredible growth in the Indian hardware market in addition to software. So India has a long way to go. Where we would want to focus is on the software companies as well as the hardware, in other words, computer hardware companies, which I think will be growing at a very fast rate going forward. Now, of course, many of these are not listed yet, but as we go forward, this will be a good development area. A company like Infosys is a very good company. I'm looking at companies that are doing the hardware for Apple, companies that are not yet listed, but are going to be listed going forward. That would be a very interesting area to develop.
Well, Ramesh Damani is now joining us. Remembering Mark Mobius, basically, he's member of BSC. Mr. Damani, good morning. Good to have you with us here, sir. Thank you for joining us. As I was saying, a sober moment, and Mr. Mobius, of course, someone who was unwavering. And I was thinking, maybe not fair to compare, the most vocal, unwavering supporter, Indian supporter of India's equity market was Mr. Rakesh Jhunjhunwala, who, of course, you knew very, very well. And I think I can't think of anyone, a foreigner, who was more unwavering in his bullishness about India than Mr. Mobius. Just your thoughts, reflections, Mr. Damani.
Yeah, thank you, Prashant. Thank you for having me and Mark Mobius. So, truly, as someone called in, and she was emerging markets. This is John Templeton. Always focused on in India was how the sensex is, what is it, and what was the FI number in India. The large credits of the FI number being positive.
Mr. Damani, apologies. I think we've got you on a scratchy line. Maybe we can just quickly fix it and come back to you. So give us a minute and we'll have Mr. Damani back on a better line and better audio. A bit scratchy there. Just maybe use that minute to look at what markets are doing. 24,356, 120 points higher. Great start, and it's come off a little bit from the high point. And the Nifty Bank is up 350. I think we've dropped off a little bit. Plateaued out a little bit as well. We've had 3 or 4 very good sessions, interrupted, of course, by Monday when the market actually did drop, and then Tuesday was a holiday. Yesterday was great, and I think this morning we are picking up a pace. Sectorally, if you can just look at what's doing well, capital market index was the top performing index yesterday, and that should come up. Defense has been doing very well. Capital market index about 1% higher. Defense we should perhaps put up. And, those are the two areas, autos and so on and so forth. Yesterday, of course, it was an everything up kind of a day. I think we have Mr. Damani back on, remembering Mark Mobius in a better line, hopefully. Mr. Damani, apologies. Please go on, sir.
Yeah, Prashant, thank you. First of all, rest in peace, Mark Mobius. He's clearly a towering figure for emerging markets. And I've had the personal opportunity to meet him and interview him when I was doing my visits of the Bazaar Street. But the thing to remember is that for 25 years in the last, not so much anymore, but for 25 years, the two most important numbers that everyone on the Bazaar Street would notice was what the index did overnight and what was the FI number. And a large part of the positive credit for FI numbers that we had for 2 decades almost belonged to John Templeton and Sir Mark Mobius for opening up emerging markets, starting with Japan in the 1960s, continuing on to Korea, Taiwan, and then on to India. I think a large part of the FI inflows that we got hooked to was thanks to them opening up the minds of Western investors, whether in New York or in London or elsewhere. So there's a huge credit to him for having discovered Indian markets and for having had such an unwavering conviction in Indian markets.
Mr. Damani, hi, morning. You said you interacted with him personally during Wizards of Dalal Street on CNBC-TV18. Anything in that interaction that stood out with you, which you carry with you in your heart, which has shaped the way you think about investing, which you learned from him?
You know, it was such a great honor, of course, to interview him. I interviewed him in Hong Kong, looking at the Frisian Harbour, just to get his insights. I think the point that he would always say, the two things he would always say, is that don't be scared of volatility. Volatility means when, opportunity beckons you. And I think this recent fall also made emphasis on the same thing, that the volatility in the market has to be endured. And at the end of the volatility is gains in the market. So I think that, and he always had this very funny saying, he said, everything that goes down will go up, meaning there was a regression to mean. I think those concepts stayed with us. And I think early in my career, he was almost considered one of the wizards of emerging markets. I think we all looked to his various books, various lectures, various notes. I remember hearing me speak on various occasions on how he felt. But I think one thing that always stood out to me was his enduring bullishness on India. And as Prashant rightly said, that in domestic markets, it was my friend Rakesh Jhunjhunwala. In emerging markets, it was probably Mark Mobius. Always bullish, always positive on the Indian market.
And that advocacy perhaps is much needed, right? Because even now, Mr. Damani, most of the foreign money we get is through emerging market funds. In terms of big global funds, we actually get very, very little of that money. Most of the money India gets is still EM funds. So that advocacy, as you put it, opening the minds of investors around the world and sort of, telling them about the India story, very important.
It is, and I think he proved in Japan. I think Templeton and Mobius proved in Japan, and then in a host of emerging markets after that. So it is important, but I think personally, if you ask me, I think this fixation we have on the FI number is a bit overstated, because at the end of the day, anytime a stock is bought or sold, there is a buyer and a seller. When FI sell, they don't sell into a vacuum. There's a buyer. It is just the price discovery that takes place in the matter. So I personally look at the movement of the prices and the index rather than the volume of whether the color of money is foreign or color of money is Indian. I think the markets probably place too much emphasis on the foreign money. I place equal importance on the domestic money.
Oh, yeah, absolutely. I think we've seen that over the last couple of years. And I must say, Mr. Mobius, once he quit and started his own fund, he was still pretty overweight on India. And he was not afraid to say that, well, money will go where capital is treated best. And we played that soundbite out in terms of entry, registration norms, and we've heard that from other investors, etc. as well. And I think the regulators acted since to ease some of those regulation. Mr. Damani, since I have you on the telly, just a quick word on markets now, Mr. Damani. How are they looking? Have we turned the corner now?
I think so, Prashant. I think the worst fears of the war are behind us now. So that is a good sign. I think the markets will tend to favor some of the things that seem to be blossoming this morning, which is perhaps defense, localized supply chain, infrastructure building. So I think we can look forward to a period of gains in the next quarter or 6 months, as opposed to the very, very sharp volatility that we experienced for the last 3 months there.
And those are the three areas you've sort of been positive for a while. I think our last conversation, you defense on your mind, you had some of the mineral resources, right? And some of the infrastructure companies. These are the three areas, themes that you still like, Mr. Damani?
Yeah, that's pretty much summarized my view. I think critical minerals, plus I think the importance of localizing supply chain, whether it's, basic raw materials. I think no country can now afford to rely on a supply chain extending, say, to the Middle East or extending to Japan, extending to China. They need to localize and develop the raw materials themselves. So other than critical minerals, also the basic raw materials, copper, aluminum, things like that. The local producers will play a more important role, I think.
These are themes which kind of emerged because of the changing world order we've seen, and we've seen it turn before our eyes. What the Iran war has shown us, of course, is energy dependence as well. You think that perhaps there aren't that many themes here? I've heard ONGC mentioned by some investors, over the last couple of, that the stock's pricing oil is about $60, $65. I don't know, is that something that you've thought about as well as a theme?
I think what the overriding lesson I've learned from the Iranian conflict is, while you're right, energy independence is, quite important, but that has been known for the last, since the OPEC crisis of 73. We've always emphasized that India has always been, very prone to shocks from what happens in West Asia. And I think we've worked a good job towards reducing our dependence on fossil fuels. But I think strikes me as most important, Prashant, is the need for asymmetrical warfare. A regional power like Iran has basically held the United States to quagmire by using cheap $4,000, $5,000, $20,000 Shahed drones, where they risk depleting their very costly and very expensive cruise missiles, patriotic missiles in America. So I think the nature of warfare has changed completely. I think planners in Delhi or planners in Washington are taking note of this fact. And I think the Indian Army budget that might be skewed towards a lot of heavy armaments might have to be rethought in terms of a lighter, more asymmetrical warfare. Because I think increasingly precision missiles and guided drones will be taken over by across the world. So it will no longer be a matter of who has the best gold-plated military, but who has more emphasis on, lighter, flexible, asymmetrical warfare. So I think the nature of warfare has changed. I think it behooves us to pay attention to those matters.
Yeah. And Mr. Damani, if you would allow me, you've been bullish on names like, BEL has been a long-time favorite, and you own a bunch of others, Garden Reach, for example. And have you added anything new in that space to kind of bet on what you call asymmetrical warfare, cheaper drones and those things?
Yeah, I have. I think sometimes in the unlisted space, we bet on drone manufacturing companies. There are some companies now in the private sector that are more valuable than, say, companies in the public sector. I have exposure to both. I have sold some of the public sector, booked some profits, I would say, in that. But increasingly, I think it's a theme that will continue to propel the market higher for the next few years. I think whether it's in the missile area, whether it's in the drone area, whether it's in the laser fighting area. So in the private space and in the unlisted space, we have made significant bets in these companies.
Significant bets in these companies. And just to sort of wrap up your earlier view, I mean, you're always invested, right? I mean, you're, of course, looking to invest as well, but largely invested both on the private and the public side as well. As you look ahead, Mr. Damani, this is a more steadier kind of pace we would be on, trajectory we'd be on, or you think it'll be very zigzag? You've of course, you warned us it's going to be pretty volatile when President Trump took over, and it's kind of sort of played out. You think it continues to be a tricky place in that sense, or steadier from here? What's your sense?
I think, except for the last 4 years, when we had a pretty smooth ride post-COVID, the index went up without really too much trouble. Markets have been, the hallmark of all markets I know have been volatility. And I think they will continue. I mean, it will be great to see the index double without too much churn, but that's very, very unlikely to happen. But I think most of us who've been investing in India for the last 30, 40 years very firmly believe is that you have to ride out the volatility. You have to make that your friend, buy on the dips, hold for the long term. I think that tends to have better outcomes and more richer money, because I think people who remain invested and not been, say, blown out by COVID or blown out by the Gulf War, I've seen a lot of the returns evaporate where the market kind of turns around sometimes on a dime. So the best strategy I can tell for the young Indians is to remain invested, remain doing the SIP, remaining doing their direct investing in Indian markets. I think we're in a good place, good time. And the volatility that you went through was blood churning. I'm not denying that. But we have learned over many 30, 40 years that that's just part of the beast.
Mr. The Money, is very, very good advice. And, the young India seems to be listening as well. I mean, look at the gross SIP flow number seems to be holding on at high levels. Thank you very much, Mr. The Money.
Sure, thanks, Prashant.
Okay, well, that is Ramesh The Money, investing veteran, remembering Mark Mobius, but of course, talking a little bit about markets as well. Remains positive. 3 themes: defense, critical minerals, resources, and infrastructure, as he's pointed out in the past as well. So very, very focused there, but defense perhaps more than the other 2 as well. We've got a corporate conversation lined up next. Nigel, take it away.
All right, let's focus on ICICI Lombard. They reported a rather good set of numbers in the 4th quarter. The gross return premium was up by close to 17%. We're joined by Mr. Gopal Palachandran, the Chief Financial Officer at ICICI Lombard, who joins in on the show. Hi, sir. Good morning. Good to see you in. Well, take us about the outlook for FY27 for the industry on the whole. What kind of growth are you looking at? And for ICICI Lombard, what's the growth number that you're penciling in?
Oh, Nigel, good morning, and good morning to all your viewers. I'm always happy to kind of connect to the channel. So honestly, I think if you look at, before I kind of specifically answer on how do we look at FY27, I think we have always maintained that from an ICICI Lombard standpoint, we will continue to seize opportunities of growing the book profitably. And that's a thought process that we get into for FY27. And therefore, from the thought process standpoint, I think the way we have always looked at writing businesses to try and see how we can continue to accrete market share. And the range that we have talked about in terms of trying to get a delta vis-a-vis the industry at an aggregate level, all lines business put together, is 100 to 200 basis points. So that's the number that we would kind of go with when we get into FY27, try and see if we can continue to have an alpha over the industry growth numbers of 100 to 200 basis points.
All right, so you're expecting to outgrow the industry growth number. Got that. Do you expect the combined ratio to be sub that 100% odd mark in FY27?
So let me again just put that in context. I think because our business is obviously kind of cyclical, and therefore to that extent, obviously you get to see experiences play out between different time cycles. And this is what we put out also in the investor earnings call that we had last evening. If you look at the 10-year average, ICICI Lombard's combined has been about 102.9%. This is in the last 10-year time cycle. Industry combined ratios has been 115%. So the delta that we have had vis-a-vis the industry has always been in excess of 10 percentage points. And specifically to your point on how do we see the trajectory of combined play out, if you look at the last 2-3 years in specific, every year we have been able to kind of see an improvement in our combined ratios on a year-on-year basis. And that is the same thought process that we would want to continue to exhibit even as we get into FY27. And more than the combined, the other metric that we have always spoken to all of you is to try and see if we can sustain that ROE trajectory of 18 to 20%. And that's also a number that got exhibited even for the current year gone by.
Thank you very much, sir, for waiting by. This is Rima here. Can you tell us what specifically led to the improvement in the combined ratio? Because it declined from 105% in Q3 to 101.2% in Q4. What were the factors which drove it? And for FY27, what is the number that you're looking at? Do you get back to, say, 101%, or would it be between 100 to 101%?
I'll take the second part first. So, Rima, I think we have always kind of put this in the context of how the market plays out, which is the reason I kind of called out that long-term average of the industry combined vis-a-vis, let's say, ICICI Lombard's combined trajectory. So we will obviously wait and see how the market responds to in FY27 from a combined ratio standpoint. Our thought process, as I said, is to try and see if we can continue to have the delta of more than 10 percentage point difference between the industry combined and, let's say, ICICI Lombard's numbers. Now, coming back to the specific point on the year gone by in terms of what has led to the improvement, honestly, I think the way we would look at is obviously to try and look at over long cycles, but definitely on a year-on-year basis. On a year-on-year basis, actually, we have seen an improvement in combined on an end basis from 102.6 to 102.4. So again, it's been an improvement in the overall combined, aided by an all across clear growth in top line coming from the preferred lines of businesses. And more importantly, what we have been able to exhibit is a better loss experience. And obviously, we have been able to kind of also make sure that we're able to create efficiencies in businesses.
Okay. And can you break that up in terms of growth for the individual sectors? Because you're guiding for a high single-digit kind of growth for motor next year, and you've generally outperformed. Does that mean we're looking at a double-digit growth for the motor segment, which is, I think, close to about 50% of your overall revenues? And then if you could talk about health and even the fire segment, where you've highlighted discounting pricing in fire insurance renewals starting 1st of April. So give us an outlook, an overview and trajectory on each of your segments.
Let's take each of the segments. I think if you look at motor, I think what we have always done is, depending on how the market environment has played out, is how we have been able to go all in terms of being able to gain incremental market share. And that is exactly what got exhibited in the second half of this year. In motor, the industry grew at about 10%. We were able to grow at about 15%. And this strong momentum that we have seen in the second half of this year is something that we are quite excited to see how hopefully that will kind of play through even as we get into FY27. Obviously, what aids growth in motor is a combination of what you rightly said, which is new vehicle sales. And two, and more importantly, from an ICICI Lombard standpoint, we have also kind of stayed focused on improving our retention numbers in terms of how many customers we are able to retain. So there again, in the year gone by, we have actually seen an improvement of almost anywhere between 3 to 5 percentage points in motor as a category. So those are the two things that we will watch for in terms of how one is looking at positioning to ride growth in FY27 for motor. On health, I think by far, and more specifically, I will confine to retail health. Retail health has been by far one of the fastest growing segment at an industry level consistently over the last 5 to 6 years. We honestly see with this renewed regulatory changes and reforms getting exhibited, the awareness on health will be continuing one, and we will see even FY27 exhibiting a significantly better outlook from a market perspective. And within that, obviously from an ICICI Lombard standpoint, we will want to continue to accrete market share as what we have done in the year gone by. In the year gone by on retail health, our market share improved from 3.3 to 4.1%. So honestly, we would want to kind of make sure that we're able to continue to exhibit incremental market share accretion in the retail health space. Commercial lines, and within that, the segment that you spoke about on fire, at this point of time, fire, we are seeing a bit elevated levels of competitive intensity. And hence, we will be slightly watchful and guarded in terms of how we want to position our book. But beyond fire, there are equally other lines in the commercial line space, which we think will be viable from an underwriting perspective. And that's something that we will go after.
All right, very quickly, sir, when does the motor price revision come about in FY27? If you could tell us when, and what is the quantum you're working with?
Honestly, at this point of time, I think that's something that we believe is something that is required from a market perspective.
Okay.
And hence, we will wait for, as and when the announcement happens, I think we will be able to talk specifics on the extent of change, what comes through. Okay. But from an industry standpoint, I think we are definitely very, very hopeful of a motor third-party price increase to happen.
What is the quantum, sir, you're expecting?
Honestly, Nigel, at this point of time, which is where I said, once the announcement happens, we will be able to kind of talk something more specifics around that.
All right. What about the draft commission regulations? There has been a lot of to and fro on that front, and my colleague Yash has been on top of that. By when do you expect that to come about?
Again, the direction is absolutely correct. And honestly, we will my response will be the same as what I mentioned for motor third party. I think we will obviously wait for the guidelines to get announced, and then obviously we will be able to talk something more specific around those.
All right, we'll leave it there. Thank you very much. Good speaking with you, and appreciate your time here on CNBC-TV18. Time for a quick commercial break here. We have the former Commerce Secretary Anup Vadavan joining us, and Abhijit Das, international trade expert. An Indian delegation from the Commerce Ministry will be visiting Washington, D.C. soon. Further talks on the bilateral trade agreement. So we'll talk about this and more. Markets, by the way, have come off 24,317, just about 1/3% left now on the Nifty. Small caps and mid caps doing much better. Okay, welcome back. With everything which has been happening on the Iran front and the war, etc., and before that, of course, there was that AI bit. We kind of sort of relegated the India-US trade talks on the back burner, but looks like things are picking up. So, day before yesterday, Prime Minister Modi held a 40-minute phone call with President Trump, and Sergio Gore, the US ambassador to India, essentially tweeted saying that it was a great conversation and stay tuned for more. So it was a bit of a cryptic message. Now, a trade delegation from India is also set to visit Washington next week to hold talks with US authorities. While India, of course, stands by the interim deal, the US SC ruling against President Trump's tariffs and USTR probes are expected to have a bearing on talks and the finalization of an agreement. Abhijit Das is with us. He's international trade expert and former head of the Center for WTO Studies. Mr. Das, good to have you with us here. Thanks very much. I guess we had to jog our memories a little bit to get exactly to the point where we left off because so much has happened since. So how do you look at this, sir? That phone call and that, that cryptic tweet and the delegation now in Washington, D.C., are things moving forward now?
Thank you for having me on your program. Yes, things appear to be moving forward. When we had last discussed about India-US trade deal, that was the occasion when the US Supreme Court had ruled against the IPA tariffs. And just to remind our audience, the IPA tariffs were the basis for the India-US interim trade agreement. Now that the legal basis of that has been knocked off, and all countries are subject to a uniform flat tariff rate of 15%. It'll be interesting to see how the Indian delegation leverages this Supreme Court decision to get a better deal for India. But we must also remember that those countries who will not be subject to or who are not negotiating with the US may end up with having a lower tariff than what countries that are negotiating with US might end up having. And then there is another new element in the entire discussion, the Section 301 tariffs. So I'm sure the Indian delegation will also take a strong stand against the US imposing Section 301 tariffs against India. So let's wait and see. But it is an interesting and a useful development, and it could pave the way forward for hopefully a balanced, fair, and equitable trade deal between India and the United States.
Yesterday, Scott Bessent, the US Treasury Secretary, basically said that the US would not renew general licenses that allowed for the temporary sale of certain Russian and Iranian oil. I'm sure you heard that. Mr. Vadavan is also with us. Since the war began, we kind of sort of were buying a lot more of Russian oil, right? And there was this temporary waiver which the US had sort of given. And now Secretary Bessent reaffirming that those licenses will not be renewed for Russian oil and Iranian oil as well. Mr. Das, is it connected? Is it pressure tactics? I mean, China and India are the big buyers, basically.
You're very right. These separate dots are actually connected. This is an attempt at getting another pressure point, another negotiating leverage, so that US can extract more concessions from India, and which is really unfortunate. The idea of trade agreements, trade negotiations being tied to larger geopolitical, non-trade related elements is not playing out in India's favor. And the government really has to stand up to that. Government has to oppose this linkage. I hope the Indian delegation will take a strong stand against this linkage.
Mr. Vadavan, come in here, sir. We were talking about, of course, what Secretary Bessent said last night, and the Indian delegation in Washington, that phone call, Sergio Gore saying, stay tuned, more coming up. Just your thoughts on the matter?
Yeah, so, what one gathers from the press seems to indicate that this again is going to be a very preliminary meeting. If you see the Commerce Secretary's statement, he talks about, discussing the structure of the negotiations, laying out the issues to be discussed, laying out the time frames. And, more importantly, what Abhijit said is very relevant, that our framework agreement signed in early February was aimed at negotiating our tariffs from a 26% reciprocal duty down to 18%. But then those 26% tariffs no longer exist after the Supreme Court order. What we face are 15% tariffs under, I think, that section 122. So obviously that framework agreement is, invalid in a sense. You can't negotiate 18% when you're actually facing 15% under US law today. And then the other important thing is this 15% also will go when that 150 days are over. It'll happen, I think, sometime in July or whenever that date is. So they also have to negotiate a new structure for the framework agreement. So everything is, again, very preliminary. And of course, we must also bring in the issue of the 301, investigations which the US has launched on child labor and some such issues which are, I think, not really valid issues for investigation as far as India is concerned. Certainly, we should take up the 301 issues. And of course, you just mentioned the issue of procuring, Iranian, Russian oil. There again, we should assert ourselves. It's a long-standing position that, we recognize only UN sanctions and not, bilateral sanctions which are unilaterally imposed. So that's another issue which we must assert ourselves on. And much, water has flown under the bridge since those sanctions were imposed, and the US itself has very conveniently relaxed those sanctions when it sees a US interest in it. So you can't just, arbitrarily switch on and off these levers which are illegal under international law in the first place. So I think all these issues we have to assert. The renegotiation of the framework agreement, which is infructuous today after the Supreme Court order, standing firm on our right to serve our economic interests by procuring our energy requirements from wherever it best suits us, and contesting the arbitrariness and in some ways unjustified nature of the Section 301, inquiries. So those are my thoughts on this.
Yeah. Just very quickly, Mr. Vadavan, if I may, right? The US ambassador to India, Sergio Gore, right, seems to be, at least from his pronouncements on social media, etc., seems to be a big advocate for better relations. I guess that's part of that's part of his job, right? But he's someone, as has been, I think, talked about and analyzed before by experts, someone who's got a direct line to President Trump and can cut through the bureaucratic clutter and kind of get in the US. And I think he said, well, I met with the entire cabinet, President Trump himself. How much weight should we put to that as a signal?
I think we should.
Yeah.
We should put a lot of weight on that as a geopolitical and a geostrategic reality. At some level, I think the US side does realize that they can't afford to take things, to this ridiculous extent, where at one point we were facing those 26% reciprocal and 25% punitive duties for buying Russian oil. And I think the corrective came based on a US initiative itself. It is a US initiative which brought in that corrective, and that is a realization that the geopolitical and geostrategic reality of, treating India in this extreme kind of manner is not acceptable and not good for any side. So that appears to be my reading of what the US ambassador is saying, that they've realized that there are some boundaries which you can't cross with India, given the geostrategic and geopolitical importance of our partnership, the long-standing nature of our partnership. So I would read it that way. That it's a realization that, and it's an expression of intent to be more reasonable and stick within some, boundaries in negotiating with India in the future. That would be my reading of the situation.
Thank you, gentlemen, for joining in, both Mr. Das and Vadhavan, for sharing your insights. Great conversation. Thank you once again for speaking to CNBC TV18. Back to the markets then. We've seen about a 100-point slip from the top for the Nifty, and the mid-cap index, which was holding up with a gain of 1%, is only up about a quarter. Shilpa Das, Prabhudas Leeladhar, is now joining in on the show. Shilpa, second day of gains for the market, but some of those gains are coming off in the first hour. What is your assessment and what's the trade?
Good morning, Rima, Prashant and Nigel, and thank you for having me on the show. Talking about the indices, we see that there is a support around 24,200, and for Bank Nifty, it is around 56,000 zones. So as long as we are holding that on near-term basis, we might see a level, a spurt on the upside towards 24,500, and for Bank Nifty, likewise 57,000, 57,500.
Okay. And stocks?
Stocks, I have two buys. The first one would be a buy in Torrent Power. It is trading at around 1,523. So I believe keep a stop loss of 1,490 and the levels of 1,580 can be seen. The other one would be a buy in Page Industries. Again, towards day highs, 36,700. It is trading now. A stop loss of 36,400 should do well. And levels of 37,500 can be expected.
Thank you, Shilpa, for joining in. Two buy recommendations from her. Get into a break. On the other side, we'll talk commodities. Manisha Gupta joins in. Welcome back. As promised, let's talk commodities. Manisha is now joining in. Manisha, it's silver on your mind today.
Well, it is, and that is because there's a Silver Institute report on estimates for 2026 in sense of demand and supply. And in any case, silver prices have been gaining quite strongly. If you look at the overnight markets, well, we've seen 3% of gains. For this week itself, we are up by nearly 7%. And for the month as well, it's been nearly 17% of gains that you have seen come in for silver prices. But interestingly, it is about the Silver Institute report, which says that the market is headed for a sixth year of supply deficit in 2026. And that has taken the prices to a one-month high is how we are trading. Silver Institute also says that with the kind of deficit that we've seen in last 5 years, 762 million ounces has been drawn from the stock since 2021. And that, by the way, is almost 1 year of mine supply. That clearly has been supportive for the prices there. This is what we are looking at in sense of deficit for 2026 at 46.3 million ounces. Last year was 40.3 million ounces, so clearly supportive for the prices there. The silver estimates, when you look forward for 2026, the industrial demand estimates are expected to see a decline of 3%. Solar is expected to see a decline of 19%. I mean, that is where the major demand has been coming in from. But data centers, EVs, you name that, and silver is used there. That is the demand that would perhaps just about continue. It is the investment demand and the retail, institutional and physical demand that is expected to continue to grow when it comes to silver. So ETF demand is expected to grow by 30 million ounces, and coin and bar physical demand, especially from India as well, is expected to continue to grow. And the global demand is estimated 18% on the higher side for this year. Now, take a look at the silver prices on what we've done in this year till time. We started with $71 an ounce. We went to all-time high of 121 within that period in 28 days. And then we saw some correction. This was during the war conflict. In March, we saw $60 an ounce, almost half of what the all-time high was in the month of January. And currently, we're holding around $80 an ounce right now. So a very volatile last 3 or 4 months is what silver is putting behind already. When it comes to the Indian markets, in the month of January, we saw an all-time high of 4,20,000 rupees a kg, currently trading at 2,50,000. We've seen a low of almost 1,98,000 as well when the international silver prices went to $60 an ounce. And finally, take a look at what the silver prices have done in an year totality. For the year, we are up by nearly 13% for the silver prices. Last year was 147% of gains, and silver in last 5 to 6 years has been constantly performing quite on the positive side. For this year as well, the expectations are that we could be going back to 100, 120. There are $150 an ounce of forecast as well for 2026.
All right, Manisha, thanks very much for that. Commodities there in focus. We're going to take a break. On the other side, our special Indianomics segment, Latha discusses the likely impact of delayed monsoon and fertilizer shortages on agriculture and rural demand growth. Ashok Gulati is her guest. That conversation up next.